Hello, hello. Good afternoon, everyone. Happy Sunday. Hope we're doing well. Let's get a audio check here. Hello, hello. Good Sunday. All right, we are good to go. Hope we're doing well. Unicorn Queen, hello, hello. Cleo, happy Sunday. Raj, hola. Mr. Niaz, hello, sir. Julian, happy to be here. We're glad to have you, man. Silk Touch, audio good. Thank you very much. Joe, hello, hello. Hope you're doing good, brother. Some phenomenal Christmas decorations you guys put up. Happy Sunday, guys. James, hello, hello. Alrighty, guys. Appreciate you joining us here this Sunday. Sort out the business for the coming week. So as always, guys, what we're going to be touching on today is what opportunities we're looking at going into the coming week for the US dollar. And again, by covering the dollar, we're essentially covering foreign currency. And you guys see how that's pretty one-to-one. From there, we'll confirm it with the bond market as usual, give you guys the institutional perspective. And then from there, we'll transition over to index futures. And I'm sure as usual, you guys are going to have some lovely questions for me. So with that, guys, let's go ahead and get right down to the business. Hope we're all having a fantastic weekend. And we're ready to get to making some fucking money this week, guys. Let's get down to it. All right, weekly forecast for December 15th, 2024. So we're closing out the year here strong, the month of December after elections, as we were predicting cleaner price action. And that is something that we are starting to see. Price action is becoming more one-sided, more symmetrical. The ranges are opening up, things that we want to see for high probability trading, right? So even though it is December, generally December is more low volume, lower volatility. However, this December has been lovely, and I expect that to continue going forward. Economic calendar, we have a boatload of high impact news here this week. Every single day we have red high impact news. Lovely for us traders. As always, my man Tommy is unpacking that in our newsletter every single day, how we're attacking the session, when we're taking our trades, and we do it again with our own live money every single week. A resource you definitely don't want to miss out on. The link for that is to sign up in our description. You can also go on our website and sign up for the newsletter there, and it'll be at your inbox, hot off the press, 8 o'clock every evening. Alrighty, so for what assets we're going to be looking at today, as always, dollar, confirming it with treasury bonds, and then from there we'll transition over to stock indices, S&P, NASDAQ, and I usually get asked about the Dow, so I'll probably touch on the Dow as well. Fresh juice, doesn't get any better than that. Intermarket analysis. So again, we're going to start with the dollar, but as always, especially if you're trading currencies, it's not enough to just look at one asset. In my opinion, it's not enough to look at one asset if you're trading anything, but especially for foreign currency, you have to confirm what you're seeing in euro, pound, Australian dollar, whatever currency you're trading. You want to have that confirmed with dollar and bonds, because that's going to confirm institutional sponsorship. For indices, it's not as necessary, but it definitely gives you just another layer of precision for what it is that you're looking at. So again, whatever you trade, you stand to benefit from having a well-rounded pre-market approach, knowing what you're looking at and why you're looking at it. So for the US dollar on the monthly time frame, so for dollar to remain bullish throughout December, the market needs to trade through the midpoint of the monthly wick. So what I have labeled here, that's where we closed last week, labeling the midpoint of this wick here. Now we traded up into that here this past week. For us to remain bullish, though, I want to see us trade to it and through it. So I want to see us to continue repricing through that, and then that takes into the previous monthly high, right? So the previous month's high is the draw, as long as we remain bullish to the upside. Hello, Carla. Hello, James. Looking down here at this wick midpoint, we had the bodies. We had the bodies there, stopping, displacing higher, disrespecting this imbalance here. Swing high here and here. All targets on the upside that we had. Once we reached several targets, again, it was reasonable for the market to retrace. And now we're looking for a bullish month of December. Moving right along to the weekly chart. So we saw support inside this weekly fair value gap as we expected. last week confirming the dollar is bullish. So we had this weekly imbalance here. Why did I expect this one? Because if there's ever two fair value gaps in a market that you're trading and you want to see bullishness, you ideally don't want to see it trade into the lower gap. Why else was I not looking for it to trade down into the lower gap? Does anybody know? What in the market structure told me we didn't need to see a deep retracement? See if you guys are taking notes. The bullish breaker over here, right? When there's a breaker. There you go, Matt. That's another point. Yeah, you got ahead of me on the next point. Love it. Yes, sir. So the fact that we stopped at midpoint, absolutely, right? Beautiful stopping in the midpoint there, and people say the markets are random. Hilarious, right? Body stopping perfectly at the midpoint there. That's an algorithmic confirmation that we look for. But look back over here. Why don't we need to see a deep retracement into this range? I get asked all the time, Dylan, why don't you expect the market to trade down into a discount? We have a dealing range. We have a low, we have a high, and the discount is here. Why don't we drop down into that? You have to understand the relationship of balanced price ranges and efficiently delivered ranges. When we have a breaker in and of itself is a balanced price range. So because we have a low and then a lower low here, what's happened here? We've traded up, down, and then we left that range. So if I could highlight a rectangle from this low to this high and extend that through, this is all efficiently delivered range. So it doesn't make sense for the market to drop all the way down to discount or below equilibrium because this is an efficiently delivered price range. So when there's a breaker, which is what these two up close candles are, extend that breaker through. That's why we expected the turning point at this fair value gap. And then as my man Ahmed pointed out, the fact that the bodies stop at the midpoint, that's just the nail in the coffin. When you know what you're looking for and then the algorithm confirms it like this, you don't need anything else to have confidence in what you're looking for. So why were we bullish last week? You see how it all comes together, right? Expansion higher last week, which is what we were expecting from this weekly fair value gap. And now for the upside for this coming week, same thing happens in indices many times, and I used to wonder. There you go. It's not a mystery anymore. Love to see the realizations, Raj. I know what it was like for me when I finally was able to put all this together, have clear understanding, knowing why you're looking for what you're looking for it, and it definitely is a good feeling. Success, BPR, there you go. Yes, sir. Islam, the series of down closed candles to the left can be considered an order block? Absolutely, right. So if this is a breaker here on the higher time frame, or sorry, if this is a breaker on the lower time frame, what's that going to be on a higher time frame? 3 down closed candles, that's a bullish order block. Every higher time frame order block is going to be a lower time frame breaker. Ooh, wow, that's really good. Having fun with you guys. All right, so you see, that's why we're looking for it to trade higher. So all those are right answers, right? The market turning there at the midpoint, great answer. The fact that this is the breaker in a balanced price range, absolutely. And then the fact that it's a bullish order block on the monthly time frame, even more confluence. Raj, can you repeat that? Yes, sir. Every lower time frame breaker is going to be a higher time frame order block, or every higher time frame order block is going to be a lower time frame breaker. Pretty straightforward. If you backtest that, you'll see that in all your examples. So several reasons for why it's turning here. Why am I covering all that? Because I want you guys to understand the why. I could come here, make it easy on myself, just say, all right, guys, this is where dollar's going. We're looking at this target. This is a turning point, and we're going higher from here. But I want you guys to genuinely know that you know. So that's why I'm going through all the details here. For those of you guys that may just want a shorter session, we will upload the PDF in and of itself up to our Twitter, probably. So you guys can go ahead and just see the targets. I know many of you guys just want targets, but several of you guys want to learn and know what it is that you're looking at, learn how to read price action. And again, that's who I want to help out here. So for upside targets for the coming week, so again, we saw support inside the weekly fair value gap, looking for another weekly expansion to premium targets. What premium targets am I looking at moving forward? We have the rejection block here, which is the highest body, and above that, the dotted line, that's going to be the midpoint of the wick. I'm going to use that as a target. And then again, we have that previous monthly high, which is a swing high. That'll be the draw on liquidity moving forward. It gets even better. Let's keep it moving. Daily chart. So we had the dealing range from this low to this high. Institutional sponsorship from discount valuation confirming bullishness. What's discount valuation? Well, from this low to this high, that's our dealing range. I covered last week why that is a dealing range. We did what? At discount. created a low, took out that low in a discount when we're bullish. I'll repeat this again. I said it last week. When we're bullish and the market trades down to short-term discount, we don't want to see market makers keep it in a discount for very long. So you see how I was able to call this intermediate term low here last week before we had all these up close candles? Because when you know what you're looking for, it's easy to anticipate market structure. So what I'm looking for here is internal to external range liquidity. What is that? How does that work? When bullish and the market drops down into the range, it's doing two things. It's allowing a discount market for smart money to buy. So below that low, I'm sure if we knew it was bullish and going higher from here, I'm relatively sure the central banks knew that as well. So they're buying the discount, but where are they going to sell the buys that they're accumulating here? The buy stops here, these equal highs I gave you last week, and up here. So internal allows them to accumulate longs at a favorable price, and then the external range liquidity up here allows them to then distribute the long positions that they accumulated in a discount. So these equal highs here was the draw that I gave you, toasted those. Next draw is going to be the midpoint of this wick here, and then through that we have the previous month's high. That's what I'm looking at with the internal to external range liquidity, like how we left some of this fair value gap open. This one down here, it's a breakaway gap, and this thing is off to the races. And we're going to confirm that with the bond market here in just a moment. So we're expecting continued bullish institutional order flow on the hourly chart if we are to remain bullish. What does that mean? Very simply put, every discount level should support price higher. If you remember last week, I gave you this as an intermediate term low. That's real market structure. That's not the bullshit that you see, the higher high, lower low. That's things that people just talk about in hindsight to sound smart, but they'll never actually predict that before the fact. This is an intermediate term low here. Why? Because everything we covered on the weekly or on the monthly, the weekly and the daily. If I'm saying this is an intermediate term low, what does that mean? You can buy anything and it'll make you money. Bullish order block here, extend that opening price through, bang. Bullish breaker here, low, lower low, highest up close, extend that through, another buying opportunity with the fair value gap. From low to high, discount, fair value gap here, another buying opportunity. Two down closed candles, that's your bullish order block, another buying opportunity here, and everything is bullish because again, we priced in an intermediate term low, which is a key low that we don't want to see violated. And then I gave you guys the market maker buy model here real time into these equal highs here. So for this to continue, I want to see bullish order flow remain, which just means every discount level should support price to the upside. Pretty straightforward stuff. All right, let's go ahead and confirm this with treasury bonds. So I want you guys to recall a couple weeks ago, the mitigation block we have been watching for the past few weeks for a retracement level. The two down closed candles here, here, and here. When we were on the buy side of the curve, or where treasuries were bullish, that's used as what? A bullish order block, right? Down closed candles, uses it as support, we leave it, right? Down closed candles, uses it as support, we leave it. Down closed candles, trades into it as support, and we leave it. When the market is bearish, right, or we're on the sell side of the curve, bullish order blocks are going to be treated as bearish mitigation blocks. So as the market's retracing, how far can it retrace? Up to the mitigation block. That's why if you understand market maker models, and not just the three little boxes and the patterns and people talking about it after the fact sounding smart, I'm talking about really understanding your market maker models. You'll understand how far the market can retrace and it still be valid. And look at how all the respective treasuries, the 10-year, the 5-year, and the 30-year, all stopping perfectly either at the high or just above the mitigation block. So that's how far the market can retrace. If you have these levels, if you know what you're looking for, which the bias has been bearish for treasuries and bullish for dollar, we look for it to retrace to these premium levels and see how it trades there. Because if it's bearish, we don't want to see it trade through these mitigation blocks because that would violate bearish institutional order flow. And then we see a huge down candle on treasuries, which further confirms what we were looking at on the dollar, right? So if we're looking at buy models on dollar and looking for higher prices on dollar, we want to see that met with lower prices on treasuries. To see how all these things start to come together to give you what some people think is arrogance, it's called confidence, right? You have confidence when you know what you're looking for. because you understand how all these things come together. And that's what I want you guys to have going into every single week. And then over time, doing this entirely on your own. So again, weak treasuries, bullish dollar. All right, let's look at the daily chart. So retracement to a short-term premium, then aggressively breaking down. I still have that gray rectangle from the weekly chart where we retraced up to on the daily. And then again, we broke down aggressively from these premium levels. So I'm looking for sell side, and this should provide lift to the dollar. These lows here, and here respectively. I want to see bonds flush down into those respective levels, and that's going to allow dollar to continue tearing higher. All right, moving over to index futures. If you guys have any questions on currency, when I circle around to the Q&A, let me know, and I'll be more than happy to cover some foreign currencies for you guys. Now that currencies are moving, old Trumpsters in office shaking and moving on the business side of things. So now there's a new breath of fresh air into the foreign currency market. So if you guys have any questions, I'll be more than happy to cover that. All right, indices. So we're seeing a crack in correlation at the highs. I know usually we go right into the NASDAQ, but there's a couple things I want to take your attention to before we get into the top-down analysis for the NASDAQ. So again, we're seeing a crack in correlation at the highs for indices. I am monitoring this going forward to measure a potential reversal, right? Potential reversal. For now, I am sticking to bullishness, sticking to my guns, looking for higher prices, avoiding calling a top. Like I always say, when the top is in, it's going to be in. We don't need to force it. However, the fact that the markets are starting to become heavily decoupled at the highs, many times that crack in correlation can indicate a potential shift is coming. However, like I said, I'm sticking with higher prices, looking for bullishness going forward. 1 second, guys. Looks like the camera's having an issue. 1 second, folks. Looks like the camera's giving me a technical difficulty. Let's see what's going on here. And hit the camera turned off. Because if the camera is the only thing, we can just keep it moving without the camera. Because it'll shut off the screen. It's all right. Let's just roll forward without the camera. That's all cool. There it goes. All right. Appreciate it. It's good. Go. You'll be all right. Take the dog too. All right, guys. We're back. Volume is a bit low. Working now? Awesome. All right, guys. I think we should be good to go. Apologize for the technical issues. All right. We should be good to go, guys. Appreciate you bearing with me. All right. So as I was saying, what I'm watching here with the... Thank you, guys. All right. So what I'm watching here with the indices, I'm not calling a top. I'm not calling a reversal. But what I am looking at is what the market's giving me. And now that we're seeing the markets be relatively decoupled at the highs, this could indicate a potential shift going forward. But as of right now, everything is still bullish on the NASDAQ. So until we get a decisive breakdown and a break in structure on that daily chart, I'm looking for higher prices on NASDAQ. So with that, let's go into the NASDAQ analysis. So NASDAQ is the strongest of the indices, with tech leading the rally, right? We have tech absolutely ripping, Tesla reaching new all-time highs. I think it was Google, Amazon, all ripping to the upside. And again, that's taking the NASDAQ up with it. So the market should find support at the weekly fair value gap for order flow to remain bullish. However, do keep in mind, we don't even need to trade down to that fair value gap. Why is that? Because this is also a balanced price range, up, down, and we left it. So from this candlestick's high, extending that through, that's a balanced price range. So I ideally don't even want to see this fair value gap filled in. I get asked many times, Dylan, in your annotations, when you're live, you're calling the market, how do you know certain gaps should stay open? How do you know some shouldn't fill in? How do you know when you want to see a gap and it's better for it to be left open? It's these types of instances here where we're breaking out of a balanced price range. I don't ideally want to see it come back and fill that entire gap. If we lose that gap, then that's telling me something entirely different. But again, as of right now, looking for continued higher prices. So last week I gave you guys a bullish weekly bias for NASDAQ and absolutely taken to the bank, right? Daily chart. So institutional order flow is still very bullish for NQ. So I will continue looking for higher prices as long as the bullish order block on the daily chart continues to support price higher. So these 2 consecutive down close candles extend that opening price through. That's your bullish order block. As long as we stay above that level, I'm looking for higher NASDAQ. Again, we had these 3 fair value gaps here. And if you guys remember, I gave you guys all this real time. This isn't just hindsight. When you have 3 of them, you want to see the market accumulate in the upper imbalance. It can stab down into the second one, but you never want to see it trade into this one because that's going to be your breakaway gap. You see how it comes together? So with that in mind, I'm looking for higher prices as long as the order block supports price. I'm looking at this retracement leg here and doing fib projections on that. I do like the 22,000 big figure number. And if you guys remember last week, I also gave you guys that 22,200 level because the target I'd given you guys, which was 21,800, that was delivered. So I don't need to have that on my chart this week because obviously that was already taken to the bank, right? So that was delivered. So what I'm looking on the upside are these targets here. Again, as long as order flow remains bullish, which everything here is confirming that to me. Moving right along to the hourly chart, a few things I'm weighing out. So generally what I do to understand the weekly range and what I want to see is I like to wait for Monday going into Tuesday, right? Same thing like last week. We're bullish, but what do we allow the market to do first? Drop, make a low of the week. So perfect Monday, Tuesday bearishness. Tuesday, low of the week. Wednesday, Thursday, Friday, expansion higher. So what I'm looking at here is there's a few different scenarios I'm weighing out, right? So this up close candle, I want to see how we trade there, see if they treat that as a bearish order block. Because if we remain below that and we're unable to get through it early in the week, then we could see a run below these lows here. However, if we start to show displacement and strength to the upside, then that could indicate that we're not going to take out these lows and trade higher. So let me show you what levels I'm working with. That is the end of the PowerPoint. So now let's transition over to the charts. These 2 wicks here are going to be influential for me. This is your ICT gray pool. So where these 2 midpoints overlap, that's a key level. So I'm going to watch how we trade there, because if we're unable to get down through these 2 wicks or the ICT gray pool, then I will be looking for higher prices from here. If we do slip through these 2 wicks here, then what I'll look for is sell side here. And then the sell side here. If we lose this key level here. Something cool I'll teach you guys while we're here. If you want to see why the market stopped here, check this out. So this is the low here, this high here. Extend this through. And let's look at that on a 30-minute chart. So you see how the bodies stop perfectly there? Why would the market stop there? Because this is the real liquidity void. Yes, we closed here and then it gapped higher, 90. So technically that's the true inefficiency, right? Technically this here would be the true imbalance. Here. However, you can refine that to this here because that's going to be the true liquidity void. This here is a balanced price range. It's already traded up, down, up, and then we gapped higher above that range. So because this is balanced here, you see how the market uses it as support because it's a efficiently delivered price range. It's a balanced price range. So because that's a balanced price range, you want to find where's the true inefficiency here with the liquidity void. And you'll see, look at the body stopping there perfectly. So that gave the short setup for Friday for the TGIF. So what I'm looking at, again, going into this week, we have all of these wicks here. So I'll see how we trade there. If we use that as support, trade higher, then I'll look for us to not take out these lows and continue. However, like I said, I'll have to see what we do going into Monday, Tuesday trading to get a feel for the weekly range. But again, you don't need the weekly range to find setups every single day. If you understand session highs, session lows, what the market's doing at time of day, you have setups every single day, and you don't even really have to worry about weekly bias. But if you want true precision, you want all these things to come together for you, then you want to understand how the monthly, the weekly, the daily, how that's flowing together. But it's not necessary if you're just now learning how to make money, if you're just now learning how to get consistent, right? These are just factors that come together to give you top tier precision. But again, you don't need top tier precision to make money. So with that in mind, guys, that's everything I had here for this one. I will probably take a look at crude oil, and then from there I'll transition over to your guys' questions. All right, so crude oil still remains in this range with what's going on around the world. A lot of interesting things. I don't know if you guys saw. They're talking about aliens now. So if things start to pick up with the aliens and in the Middle East, I do expect crude oil to get significant lift. However, we do have to leave this range. As long as crude oil stays in this consolidation range here, I'm personally not as interested in trading it, right? It's still tradable. You can still scalp this market, absolutely. However, for directional, clean, sustained, one-sided price runs, I do want to see us leave this consolidation range here. So if things continue in the direction that they are with Israel, other countries around the world, saber rattling, making threats, throwing bombs, all the above, right? I'm not getting into any of the details. That's way beyond what we're talking about here. We're here to focus on the markets and making money. But as long as those things do continue and continue to escalate, threats continue to be made, bombs continue to be launched, we will see higher crude oil. So that's what I'm watching going forward. But we do have to leave the range. We have to leave the range for the market to clean up and for there to be one-sided opportunities for me to call the market to you guys. However, we are starting to get early indications that it's wanting to break out to the upside. However, we have been in a prolonged consolidation. And even if I call markets in this or call targets in these types of markets, it will look like amateur hour even for me. I know what market conditions I'm going to perform really well in. I know what market conditions I'm not likely to perform well in, right? And that's a superpower to learn as a trader, right? So with that, guys, that's everything I had on the agenda here today. What have you guys got for me? See a few in here already. Let me scroll up. Islam, the series of down close candles on the left, can that be considered an order block? Yes, sir. Yes, sir. From where you're talking about the US dollar, absolutely. Raj, same things happen in indices? Yes, sir. Yes, sir. Happens in all markets. Ryan, can you take a look at indices? Already did. Sweet. Unicorn, looking at the highs on all three indices, can you point out where you would look to qualify a confirmed bearish breaker? It looks like some consolidation, but sometimes that swing low forms and confirmed with just a few candles. The daily chart. Yeah, great question. Let me take a look at it. Let's go over to NASDAQ. Yeah, let's go ahead and take that off. So what would confirm bearishness and a shift in market structure to the downside and a confirmed bearish breaker would be the order block, right? So if I'm bullish, I'm telling you guys the market should find support inside this bullish order block, right? And you can see we dropped down on Tuesday. Thursday rather, we made the low inside that candle and traded higher using it as support, right? That's what we traditionally expect from a bullish order block, right? Same thing here. Bullish order block, it drops down into it. We want to see it support price and send it higher. However, what would confirm the market would be bearish or create a bearish breaker? Well, then it should do the opposite here, right? What would be an expected support level should then be traded to, through, and sell off, right? So now apply that same logic here, right? If I'm showing you, I'm going to show you how to do it right. So I want to show you through a couple examples. So same thing here with this order block. If we have this range here that we want to see support price, well, if we trade down through it, that's indicating something different. And if we trade back up into it, and then it starts to show weakness signatures here and break down, then that would confirm that this is no longer a bullish order block, but a bearish breaker. So all these PD arrays have an inversion aspect. It just depends on what the market's giving you and what the market structure is showing at that time. Working now. Thanks, Cyclops. Clear. Raj, Broadcom, yeah, Broadcom's also rallying. Yeah, a lot of the tech companies are ripping. Strat King, Dylan, we roll this week, so won't these numbers change? Great question, right? So we are transitioning over to the March delivery contract likely this week, and I know I usually get questions on, well, how do you know when to switch over? Phenomenal question. You look at the open interest on barchart.com, and that's what I use to roll over. Those of you guys that are in the community or even in the free community, we'll let you guys know when we roll over. You guys will see it in the charts when either myself or my team are calling the markets to. You guys will see when we roll over to the next month out of delivery. So no, that is September. And Q. Hold on, what was March? H, that's right. So as you said, won't these numbers change? Absolutely, right? They will change because you're changing from the December delivery futures contract to the March contract. So what do you do when that's the case, right? Because the numbers are going to be different, but the method remains the same. So if that order block is this price, it's just going to be that candle on this contract. Or if I'm using fib projections to give you these targets on the previous month's contract, then you just do the same thing here for the March delivery, and it's going to give you the same levels but different prices. So that's what I do when I roll over. The analysis remains the same. I just have to roll over what I'm looking for into the new contract month. And let me go ahead and show you guys, since we're here, show you guys how to determine when we roll over. Well, let me keep taking more questions if you guys want to know how to roll over somewhere. Strat King, don't forget YM, you said. Yeah, let me go and take a look at the Dow. Appreciate the reminder. Yes, sir, I did say that. I did say that. Let's take a look at the Dow. All right, so the Dow's bearish, right? We had this small imbalance here, which we've now closed down through. But what's really interesting to me is how we closed down through 50% of this down close candle, right? This is an order block. This is the propulsion candle. So the fact that we've closed down through 50% of that, that's bearish for Dow. So Dow, just looking at it in and of itself, this is weak for Dow. I'm not looking for bullishness on the Dow. And then if we look at the daily chart, we had what? 6 days of just continuous selling. So what I'll be looking for here in the Dow. So here we got an immediate rebalance. So this is not a fair value gap. This is immediate rebalance here. One imbalance, 2, 3, yeah. So Dow's very heavy. What I'll be looking at here is this inversion fair value gap here. And we'll want to see it stay below that. If it's going to be bearish, we would not want to see it trade up through this entire inversion fair value gap. So as long as you remain below this IFVG here, I would want to see the market trade down into this fair value gap here. And then how we trade there will be really important for Dow. So 2 scenarios that I'm looking at here. If it wants to follow NASDAQ and keep trading higher, then it can use this level of support, trade higher. But if we close down through it, then that would be weak, and then I would look for lower prices. So first target on Dow to the downside would be this fair value gap. Second target would be the rejection block here. Through the rejection block, we have the wick midpoint, and then we have the ultimate low down here for Dow. Open interest is pretty low. Yeah, open interest has been relatively low. I believe you're talking about indices. If you're not, you can correct me, but open interest has been relatively low, especially at all-time highs. So one of the things that my associate, Tommy, who's our lead macro analyst, he knows that side of things way better than I do. When we're at all-time highs for an asset, it's natural for open interest to be low, especially for indices, how they are at all-time highs. That's a normal event. Raj, how much of an impact does macro and sentiment have on the algorithms like international investors, bullishness of the US market, Bitcoin crazy, animal spirits, Nvidia, China? Yeah, I gotcha. Really good question. Really good question. So, what I focused on in my trading, what I'm focused on is things I can actually see, measure, and lay my eyes on, right? Things that are tangible. The open, high, low, and close and the time of day on these markets tells me everything I need to know. Because, like you said, I mean, there's just so many things to consider, right? I mean, and there's even 30 more things, right? With the wars going on, the aliens that are now, uh, the UFOs that are in the sky, right? All these factors. How do you use that in your trading, right? It's almost impossible. Or, for example, like we have this Wednesday, right? We have FOMC on Wednesday. We have the interest rate announcement, right? How's that going to change the market sentiment, all these other things? So what I've realized, and I used to play that game. That's how I know it's a loser's game, because I used to trade like that. Like I used to go into the market, see, all right, what's the interest rate announcement? Oh, this is really bullish for index markets. It's time to buy it. And it craters, right? And then they justify it after the fact saying, oh, well, it was already priced in, so that's why the market drops. But nobody ever said that before. So saying all that to say, I've learned to focus on what I can measure, because the algorithms are referring to the open, high, low, and close, and time of year, time of month, time of week, and time of day. And what I've realized is that's all I can control, that's all I can measure, and that's all I need for precision in my trading. So in fact, I don't weigh any of that stuff out. Like, it's going to have an impact on the market, but it's going to be reflected in the data in the candlesticks. So I focus on what I can control, what's going to help me, and it's none of the outside factors, and it's everything that has to do with the candlesticks, right? If the FOMC is going to change the rates, great. We'll see that reflected in the treasury market, right? And we don't need to waste our time listening to Fed Chair Powell talking, listen to all that nonsense, look at the markets. Everything you need to know is fundamentally in the charts. Great question. Success, can you talk a little bit about grade pools? Haven't used it. What is a grade pool? Are you a private ICT student by any chance? No, sir. No, sir. I am a YouTube student. proudly a YouTube student. Yeah, I'll share about grade pools with you guys. I see some people getting angry at the old man. Say, man, this old man's teaching too many things. He's just trying to keep you learning, waste everybody's time. It's all about precision, right? If you want these levels, you have them. If you don't need them, you don't need them to make money, right? It's just about what makes the most sense to you, where you're at in your development. If you're still not profitable, would I worry about the Reaper, gray pools, implied fair value? Would I worry about all that? Probably not, right? But if you're more advanced, you want to learn everything that there is to know, then there's that level of precision that's available to you. But it's a losing argument to say everybody needs it, or that's a waste of time, because, you know, if you want precision, why wouldn't you want to have all these levels at your disposal, right? But you also have to balance that, because if you're developing and now you just have 300 things on your chart, well, how's that really going to help you, right? So you have to be real with yourself, understand where you're at in your experience level, and does it make sense for you to even incorporate all these aspects of precision? So before I got that question, I figured I'd go ahead and address it. So what is an ICT grade pool? When we see two wicks like this overlapping, you want to get the midpoint of this wick here, and then the midpoint of this wick here. And you can treat it basically like a fair value gap. It'll be a reactionary level. This is an implied fair value gap, where when you have two wicks overlapping like this, you get the midpoint here, and then you get the midpoint here. That's an implied fair value gap. So don't confuse the two. This is a grade pool. This is an implied fair value gap, and you'll see where it made the low of the day here, right? So if you want these levels, they're there, but no one's holding a gun to your head saying you have to learn everything ICT's making available. If you want them, they're there, but again, no obligation. So the difference between an implied fair value gap and a grade pool. And Dylan, do you have any suggestions for how to tackle London trading? Usually say New York AM is the best, as you have London to work from. I'm in London, so it feels like a waste not to trade. Any suggestions? Absolutely. So here's my recommendation. It also depends on where you're at in your development as well. If you're just starting out, right? If you're just starting to find profitability, maybe you're just now finding a model, or you're just now finding a little bit of consistency, I would recommend following and trading one market and one market section. Because what that's going to help you do is not dilute your attention. Because over time, you can learn to trade London, pre-market, AM session, the lunch macro, the PM session, the last hour of trading. I mean, you can trade all that with more experience. But what are we all here to do? We're all here to make money. So how do you get to the point of making money the quickest? One market, one session, one model. So with that in mind, that's something that you would have to reflect on. If you can only trade the London session, then there's nothing wrong with trading the London session. I always say you have an advantage trading the New York session because you can understand the daily range better because now you have the data and the feedback of what London has done. However, London is still a perfectly suitable time to trade. There's plenty of volatility and there's plenty of opportunities in the London session. So it just really depends on where you're at, a few factors to weigh out, but there's nothing wrong with trading the London session. But what we don't want to do, mistakes that people have ran into in the past that I've coached and trained, is trying to trade too many sessions. So if you're trying to trade London, AM, PM session, then you're absolutely setting yourself up for failure. So it's just a matter of understanding where you're at, what your personal circumstances allow you to trade, right? If you can only trade the London session, then it's a great session to trade and frame your trading business around. Absolutely. And if you do have any specific questions on how to trade the London session, those are some insights that I can give either on the next one, or if you are in the community, be more than happy to give you a breakdown on that. CM, how do you differentiate between using a group of candles as the order block or using the last candle? Phenomenal question. So it depends on several factors. Like if we go to the daily chart here. So we'll use this example here. This is one that we called live here using this down close candle. So I want to use this one. So why would I use this down close here? Because on the daily chart, it's a refinement to these two down close. Because if we go to the weekly, what you'll see is this here, this is the one consecutive down close candle, right? And then you can see on the weekly, that's the bullish order block there. But on the daily chart, you want to be able to refine that because that's why we go through the time frames, right? We go monthly, weekly, daily, hourly, 15, 5, 1 minute, so that we can refine and have more precision elements. So as I drop down to a daily chart, well, I don't want the huge range that's on the weekly chart. I want to refine it to a more precise, specific level on this specific time frame. So on the daily, I would just use one consecutive down close candle here. A lot of it is an experience factor as well. And then let's go to another example. Here we have two consecutive down close candles. So here I'm going to use both because they're two consecutive down close candles. That's one consecutive bullish order block. So I wouldn't just use the down close here. I'd use both of them in this example. If I were to refine this, right, let's say like, for example, I'm going to drop down into a 12-hour chart. Well, now you see, well, what was the two down close candles now, this becomes the order block here on the 12-hour chart. So it's a matter of refining it through the time frame. So you can see on the daily, clearly it's these two consecutive down close candles. But then if you drop down to the 12-hour, right, this is the last down close. So it's understanding what time frame you're looking at and mapping out your PD arrays based off the correct time frame. Hit the like button. Yes, thank you very much. If you've gotten any value from the session, you learned something, maybe you're more prepared for the week, do give us a like on your way out. Greatly appreciate it. Raj, thanks. Awesome. True hater like the guy's provided a ton. Absolutely. Absolutely. All respects to Mr. ICT. No doubt. Hit the like button. Absolutely. Really appreciate you guys. Ali was just curious about the grade pool. Yeah, I got you. Yeah, it's very interesting. Very interesting how deep the rabbit hole goes. Damn, never knew anything about implied fair value gaps, so thank you, sir. Awesome. Awesome. Learning something new. Ali, you think we can trade the Asian session? Yeah, absolutely. Absolutely. The Asian session is tradable, no doubt. You have to know what you're looking for, though, because many times Asia session is a consolidation profile. And if you are trading a consolidation profile, you just have to understand how to navigate certain market profiles, right? So if you're trading Asia and it's consolidation, then what are you going to look for? Fair value. Find your new day opening gap. find your equilibrium of the range that you're trading in, right? And those are all levels that you can use to get a consistent supply setups during the Asian session. And great, thanks, Dylan. Absolutely, absolutely. Phenomenal question. Raj, strategy for different sessions, please. Absolutely, guys. Absolutely. You guys can tell I've been putting in the work on the YouTube channel. Got the AM session protocols out. We'll be looking to do the PM session here going forward. And then maybe I'll throw in what I do for London. I don't trade the London session, but if I did trade the London session, what would my protocols be? Maybe I'll look to do something like that for you guys as well. But like I said, we're putting in the work on the YouTube channel. We're actually in the process of building our free course or our free boot camp on our YouTube channel. So we're in the process of making that. So any suggestions you guys have, things you guys want to see more of, let us know, drop them in the comments, and I'll look to get that done with my team. Chris, Dylan, it's always a pleasure to learn from you. Top man. Appreciate you, Chris. Thanks for joining, brother. Unicorn, when you have a series of candles for the order block, do you get the constant encroachment of it using the bodies of the candles or the whole candle and the wick? I use the entire candle, right? So let's go to the... So if I'm looking at the mean threshold or the 50% level of an order block, then I'll use from high to the low. That's personally what serves me well. That's what it is that I do. So from the high to the low, the highest wick to the lowest low, I use the midpoint. One of the reasons I believe ICT taught before when I was following him a long time ago with the Forex side of things, I think he used to do a lot more with the bodies in Forex because the wicks would all be different in Forex, right? One broker is going to have this wick, another broker is going to have this wick. So it was really inaccurate to use the wicks because they're all different. So it was easier to use the bodies, I'm thinking, for the Forex side of things. Whatever, that's what I was seeing, how he potentially used it before. I use from wick high to wick low for indices because we all have the same high, we all have the same low, and there's a lot more precision in indices as opposed to the currency market. Great question. Ali, thank you so much. Absolutely. SK, always hit the like button. Absolutely. Appreciate the gentle reminder, guys. Islam, this guy coming up over here to help us. Kindly hit the like button for him. Thanks, Dylan, for everything. Yes, my pleasure. My pleasure. Reaper, got here late. I'll see the recorded. Absolutely. We'll make it available for you guys to review at your convenience. Strat King, glad to see you making content, not just the lives here on YouTube. Yeah, I got more coming for you guys. Got more coming for you guys. London protocol would be absolutely brilliant. Thanks. Absolutely. Yeah, I will share that. Unicorn, suggestions for boot camp backtesting sessions. Oh, that's a good one. That's a good one. I just made a review on how to backtest within the community, but maybe I'll look to do something on the YouTube for you guys. That'll be a good one. That'll be a good one. I appreciate the suggestion. I'll look to do that. Maybe I'll include a couple recordings of what a backtesting session looks like to me, what it means to me, because I have a little different viewpoint. I know a lot of people do FX replay, and while FX replay is fairly decent, there's a lot more ways to get value from the time that you're investing. And in my opinion, you're missing a lot of information on FX replay if you're not looking at the S&P, if you're not looking at the dollar, if you're not looking at all the time frames as you go through your analysis. So it can skew your results. And in my opinion, I have a much more effective way of investing your time day to day to backtest, but get more insight. Because every single day is a backtesting opportunity. Every daily candle that forms, you can investigate it, break it down, journal it, and that's what I refer to as backtesting. That's how I got to my level of mastery. That's how I get others to the level of mastery you guys have seen me be able to train others to do. And it's through doing what I call backtesting. But everyone has a slightly different variation of what they think that is. So I will look to do that on the YouTube and add it as part of our free YouTube course, showing you guys how to backtest, how to get in the reps, because it was something that was a game changer when I began implementing it years ago. Med, happy holidays, Dylan. To you as well, man. To you as well. Appreciate everything. Take care. Yes, sir, brother. You as well, man. When do you use mitigation blocks? So mitigation blocks are going to be used on the sell side of the curve. So when the market is bearish and it's no longer on the buy side of the curve, then all the PD arrays that were on the buy side of the curve, you want to extend them through, and they'll be used on the sell side of the curve for premium levels or for retracement levels. Because it allows the institutionally minded smart money investors to recapitalize on the old order flow, right? Like if there's an order block on the buy side of the curve, why is it going to want to mitigate those orders? Because it's going to offer them the opportunity to mitigate those trades and also add to new trades in the underlying direction. All right, I see some spamming going on. Let's chill out with the spamming, gentlemen. Hey, Dora, I had a question, just got on here. If you're trading Monday and want to use the opening range gap, can you use the 414 settlement from Friday and the opening price from 9:30 Monday morning? Absolutely. Yes, sir. That's exactly what you do. You find where we settled at 414, the previous closing, that previous trading day where we closed, and then the 9:30 opening price, and that's how you're going to use your opening range gap. Absolutely. Unicorn suggestions for bootcamp, how to journal your trades properly. Love that. Love that. I'll get some examples of all those. It's really good stuff. FX replay didn't work for me. The interface is just not good. Plus, they don't have MNQ. Yeah, I haven't personally used them, but I have worked with people that do, and I think there's more effective ways to do it. But hey, if it works for you, then that's awesome. Please, I need help, but I bought trading and I can't see the 15. You bought TradingView and you can't see the 15-second. What happened? So I believe that would be a question for TradingView support. I'm not TradingView support. However, one of the things that could speed along your process is to access the seconds time frame. You do need the, I forgot what it's called. I believe it's called the Pro. I think there's like a, I'm forgetting the word. I know it's like something premium and Pro. I believe you need the Pro or the highest level membership level with TradingView to be able to see the seconds time frame. So I would look at what subscription package you have with them, and then from there you can figure out why it is that you don't have it. But if you do have the highest level subscription and you don't have seconds, then premium, that's what it is, guys. Appreciate it. Yeah. So if you have the premium package and you don't have seconds time frame, then that would be something to sort out with the TradingView support. Adrian, thank you. Priceless. My pleasure, man. Frank, appreciate you, brother. Thanks, man. SK, looking forward to your backtesting session. Absolutely, looking forward to it. Reaper, thanks, man. ICT himself can't explain like that. I think he can. I think he can. ICT's his own person, though. I think he likes to make it difficult. Like he says, only the strong. Only the strong. So ICT's got his own thing going on. But hey, I'll respect ICT. I'll respect ICT. I'm just showing you guys again how I use his concepts, how I've made them profitable for myself and my team, and how we make fucking bank, right? If you want to learn directly from him, then Mr. ICT's got his YouTube channel up. Not reinventing the wheel, just showing you guys what makes money. Sky, awesome, brother. Thank you so much. Absolutely. Joe, for the bootcamp, systematic way of beginning to trade micro NQ. What do you mean by that, Joe? With scaling, like how to start, how to scale, and how to get to a point to where you're making monthly salary, yearly salaries. Is that what you're referring to? Yes? Okay, gotcha. Yeah, scaling plan. I like that. How to scale, how to start, and how to scale. Oh, I need to write all these down. I'll screenshot the chat when I get done. I love that. Yeah, I want to show you guys how to, because that's something that whenever I'm coaching or I'm mentoring someone, you always got to know where you're starting and how to scale, right? Because the worst thing to do is start trading in a demo account or start trading one micro and then get bored of it for a week and impulsively say, all right, it's time to scale up, and you start trading 2 or 3 minis and you have no idea why you keep blowing up. Just like you plan when you're in drawdown and you reduce your risk, you also need to plan for scaling, right? Like how do you scale in a sustainable way and do it in a way that makes sense? How do you grow from 1 micro to 2 micros to 3 micros to eventually 1 mini, 2 minis? There needs to be a game plan to outline that. And if that would be helpful for you guys in the YouTube, maybe I'll throw that in there as well. I like that. I like that. How to scale your trading. Because you got to start small and then you got to grow, right? Anyone that's telling you get rich quick, get funded in 12 weeks, turn it off. Turn it off. They're going to lead you to the slaughterhouse. But if you want to learn how to do it the right way, start with demo trading, getting experience, growing a little bit. When you start trading live money, start trading 1 micro. As you build up either $1,000 or $2,000 of equity, add another micro, right? You're not going to get rich in 2 weeks, but no one said that. You can get rich quick, but quick isn't the definition you're thinking of right now. Most people think, oh, I can get rich quick in 1 day or 1 week, and that's total bullshit. But you can get rich quick in 1 to 2 years and start building rich and start building wealth in 1 to 2 years, which is quick, but it's just probably not as quick as you're thinking right now. It's just all about aligning your mindset, having the right mindset going into it, and that's going to carry you all the way through to consistent profitability. Ali, do you have private mentorship? So right now I have a community which we are in the process of not opening new spots for, but I do have something coming here soon which is going to change the game. It's going to change the game. Stay tuned. Raj, we see the morning market analysis on some days and not on some days. Is there a reason behind it? What do you mean, Raj? Within the Discord? Yeah, within the Discord, I'm trading live every day. Once in a while, when my other analyst wants to take the time to call the market for you guys in the free section of the Discord, he takes usually about one to 2 days a week to do that. But you guys got to keep in mind, guys, we're really trading. We're really managing our own money, right? You notice I'm not here begging for you to sign up for my Discord, begging you guys to sign up for my mentorship, because remember, guys, at the end of the day, we really trade, right? Like, we actually do this. We actually make money from our trading. So that's our focus. In the process, we do coach others to consistent profitability with the right skill sets, with the right learning. But again, no spoon feeding on our side. Hey man, don't mean to spam. How can I join your Discord? Is it all paid or is there a free community? I'd love to get in there. Yeah, so the community section is paid, obviously, for our time, for everything that we're putting into it in terms of our time investment, right? Because I could just be trading by myself, right? And making money, doing my own thing. So to make that time, make the resource available for my team to make it possible, it does require a fee to get into our community, because obviously that's reasonable, right? Businesses aren't charities. So there is a fee to get into the community. However, if you can't invest in yourself to learn it quicker, that's not a problem. We're still making free YouTube content. We're providing education every single day inside our free Discord, because we want to help everybody out, not only those that are able to invest in themselves. Reaper, of course you can, but you deliver the content differently. That works for me. You may say the exact words, but I learned it. Thanks, man. God bless. Appreciate the feedback, Reaper. Really glad to hear that. Any promotions for the holidays? I wish, guys, but our prices are our prices. We could charge a lot more, so we don't negotiate on our prices, guys. If you can't make the investment in yourself, that's not a problem. Like I said, we're still putting in the work to make sure even those of you guys that are in the free community maybe aren't able to invest in yourself just yet, not a problem. We're still making value for you guys. So we got you covered. Unicorn, thanks, Dylan. I'm part of the community, and I can say you're a real trader and very knowledgeable. Really appreciate it, Unicorn Queen. Thank you very much. Thank you very much, guys. As always, going on about an hour and 5 minutes here. Love hanging out with you guys. Would be here my whole Sunday, but I do have other things to get to here to prepare for the week. With that, guys, appreciate you joining us. Have a phenomenal rest of your week. Happy holidays and Merry Christmas to all you guys here. And I will see you on the next one. Cheers, brother. Thanks for your time. Loads of value as always. Thank you very much. Silk Touch, what you teach has been enough for me to make 50% of my income by trading spot crypto with the same logic. It works. Much appreciated. There you go. And that's how you want to go at it, right? Little by little. Make a quarter of your income. Then make half of your income, then replace your income. Then maybe in a year, double your income. Then you can confidently quit your job and do it in a real sustainable way. Love to hear that. Love to see you guys growing. That's progress. Merry Christmas. Absolutely. Richard, thanks. And back to you. Appreciate you guys. Got in. Looking forward to learning with everyone. Thank you for all the value. Looking forward to it as well, guys. Take care. Have a blessed rest of your Sunday, guys. And I'll see you on the next one. Stay safe, everyone.